Oh, hi, Greg.
Yep.
Thanks for joining us. We really appreciate it.
Thank you for having me on. I appreciate it.
All right, Greg Protiva. Well, I love the fact that you said yes, because I think there are a lot of myths about what's going on in lending. I am doing a series of interviews with my favorite people, you being one of them,
Awesome. Thank you.
on taking steps right now. There's so many things we can't control right now. So many things we can't control. And the things that we can control are what I believe people need to fixate on. And if I am a home buyer, I wanted to ask you, since, I mean, I've known you since before Jim was born. I've just transferred the overalls I wore every day into leggings.
I remember that. Yeah. I met you your first year in the business.
It's gross. Those overalls have been burned. Actually, I tried to donate them to charity and they wouldn't take them. But
That's fine.
I could make masks out of them now, though. A lot of masks with how bad they were. But
come on.
Three things. I think it's really important we keep things simple and like in groups of three. If I were trying to buy a house, what are you seeing has been the most impacted with this economic situation we're in?
Well, that's a great question. And I think that there's been a lot of impact, but let's focus on the positive first, and then I can talk about the negative. The positive is unbelievably low interest rates. We are seeing interest rates as low as I've ever seen in the 27 years I've been doing this. And they say historically, since Fannie Mae and Freddie Mac 50 years ago started, they're as low as they ever have been. And to give you an idea, they're down around 3% or so for a conforming loan amount. Now, what does that mean? Well, last year, a rate on right now was around 4.25. So now you're down at 3%. Well, if you're at $2,000 a month payment for principal and interest, last year that would have been about a $400,000 loan. Now, because the rate's so much lower, that same $2,000 will actually let you borrow $470,000.
Wow.
For the same amount. So what it's done is it's actually, and there's not a lot of focus on this in the media, it's giving any home buyer out there 15% purchasing power or more in some of the higher brackets, just because the rates are low. So to me, that is definitely the best thing. And frankly, in my opinion, the most important thing that I've seen with the whole COVID-19.
Got it. Is there a negative? You said let's start with the positive. What?
So the negatives are that I've seen is the cost of PMI. So that's private mortgage insurance. That's required if you don't put the magical 20% down. That cost has gone up, and it's gone up quite a bit. It's gone up anywhere from 20 to 40%. And I reached out to a couple of PMI reps because I'm like, what's going on here, guys and gals?
Yeah.
And they're like, look, this is risk-based pricing. We don't know what's going to happen down the road with foreclosures, with mortgage forbearances. So we've got to calculate that. And that's been unfortunate, but frankly, I understand. And, you know, the quickest, easiest way to avoid that is to put 20% down, and then PMI gets thrown out of the conversation.
And I know this is not really what you and I've talked about, but I've heard it. And so I'm coming straight to you as the source. Are there some lending servicers who aren't doing loans for anything, any credit scores less than like 700 or 670, or what's the low watermark for people right now that you're seeing?
Yeah. So one thing that's tightened up a lot, what drives what I do at my level is what's happening several levels above. And this money's got to come from somewhere. So what happens is they create securities, mortgage-backed securities, and those securities are sold on the secondary market on Wall Street. And right now, there's not very much appetite for anything other than the true Fannie Mae, Freddie Mac loan programs and products out there. So FHA mortgage-backed securities, VA mortgage-backed securities, all these government programs, yeah, they're still out there, but the investor appetite isn't that great. So on an FHA loan, you know, back in January, I could have done a loan for if you had a 620 score, and investors want to see 680.
Wow. Okay.
Some of the jumbo programs used to be able to go up to 90%. Jumbo 2 is taking a big hit because, again, that doesn't have Fannie Mae and Freddie Mac involvement. So you used to be able to buy $1 million house, you put 10% down.
Right.
Now you have to put 20% down. some of the investors, and this doesn't help, this doesn't affect home buyers. Some of the investors they're no longer doing cash out refinances. So you can't take out a bigger loan to pay off your existing loan.
Oh.
But just kind of on the fringe. So the higher side, the jumbo, and then the FHA and VA with a credit score increase requirement, that's what we're seeing. I will tell you that as a whole, that's not going to have a significant impact on your average home buyer. So that's good. And I don't know, maybe they'll continue contracting. I definitely saw some of this happen back in 07, kind of the beginning of the storm that we went through then. We'll see what this storm's like.
Greg, again, I'm going off script, but can you draw any parallels between 07 and today?
Yes and no. What's similar is that the Federal Reserve, our government, has stepped in and said, hey, we're going to help stabilize things and we're going to keep the train moving. Okay. So that's good. Lenders are still out there. They're contracting a little bit, but they're still there. That's good. The unknown here is that this came so fast. This came in a matter of 2 or 3 weeks. And so what we're seeing is this huge increase in unemployment. Now, realistically, hopefully this is a temporary thing. Hopefully we're out of the woods, by the fall. And when I say out of the woods is, businesses are back running, people are back working, because that's what you need to have a stable economy. The one difference, and I do want to talk about this in a little bit, is the one difference between 07 and 08 and now is that we didn't really have all of a sudden this massive influx of mortgage forbearances.
Well,
then.
yeah,
we had short
define
sales, we had
that.
foreclosures. Okay.
What is a forbearance?
Well, let's talk about forbearance. And I will tell you right now, before I even explain what it is, if you are a home buyer now, or you plan to be a home buyer in the near future, and let's define that, let's say within the next 2 years, probably the worst thing you could do is put current mortgage into forbearance. Okay. And I tell you that with what I know and also what I'm speculating could happen. And I don't know if it will, but let me tell you the story.
I feel like you're underlining.
It's not forgiveness.
You're underlining that. Do not go put your house in forbearance for the next 2 years or so.
Do not. No, don't put it in now.
Right.
And I'll explain to you on that. So, okay. So forbearance is you contact your lender. So let me back up a second. The stimulus program that rolled out, the government said, if you have a VA loan, an FHA loan, or a loan that's backed by Fannie Mae or Freddie Mac, you automatically get forbearance. You don't even have to show cause. Okay. And those loans, that's about 80% or so of this current DC marketplace. So that's a lot of home buyers that now can put their home in forbearance and don't even have to show cause. Okay. I could probably call and put my loan in forbearance if I wanted to. But here's why it's a bad idea. Number one, it's not forgiveness. Okay. So if you push 3 months off, a lot of the servicers are saying, okay, that's great, but now you're going to owe us the 3 months of payments that you didn't pay. Okay. So the problem I see with that is, you know, the stimulus program, the government, they didn't give enough detail or enough instruction. So they said anyone can get up to a 6-month forbearance and another 6 months if they need it, but they didn't give any instruction on how the lenders have to then regain that money. So a lot of lenders are going to want that money back right away, which I think is going to be a financial burden for somebody. The best option is if the lender will say, hey, I'm going to tack this on to the back end of the loan. So now here's why it's not a good idea. If your loan is in forbearance right now and you want to refinance, we can't do that. We have specific instructions from all the investors out there that are saying, if your loan's in forbearance, you cannot refinance. So knowing that, my concern is this: a year from now, if you want to be a home buyer, or November, if you want to be a home buyer, and let me back up. The agreement that the government has is if somebody goes into forbearance now, they won't be reported late. They won't have to pay late fees. It won't show on their credit report. Okay. But if you do that now, that's great. We don't see it on the credit report. But when we go to get the payoff on your loan, we're going to see that you're in forbearance, and it's going to kill the deal for the refinance. So I envision a situation where down the road, the lenders are going to say, hey, the COVID thing's passed. It was horrible, but you did go into forbearance, and now we're going to make you wait a year or 2 years from the date of the end of the forbearance before we're willing to lend to you. Now, how would they do that? They could simply provide a disclosure that says, answer the question.
Right.
And you've got to sign that. And if you lied on that, you know, that's mortgage fraud. So that is somewhat my speculation. I have no idea if that's going to happen. But when I look at, I can use 07 and 08 as a case study. If you modified your loan back then, there was a waiting period between the modification of your old loan before you could get a new loan. Today, if you had a short sale, if you had a foreclosure, there's a wait period between the time you can get a new loan. So do not go into forbearance unless it's your absolute last option, particularly if you plan to borrow mortgage money in the next couple of years.
All right. So I'm a buyer. What should I do? How do I plan for the other side?
Well, now more than ever, it's important to form a relationship with your lender. Okay. These are tough times. I'm in my basement. You're at your house. My staff is working in their houses, but we're getting things done. Okay. And to have a specific person, a loan officer that's going to look for your best interest through this is really important, because the guidelines are changing all the time and they're also becoming more restrictive. So for example, we've got to re-verify your employment 3 days prior to you closing on the house. Okay.
I heard it was.
You think, oh, that's not a big deal. Well, who's sitting in the HR department your building? Nobody is. Those people are working at home. So, you know, at the very beginning, I tell people, I'm like, look, we're going to get through this. I'm going to need your help, and I'm going to need the help of your company, because I'm going to have to send, or my staff's going to have to send an email to your HR rep at home or call them or whatever to verify your employment. And we got to do that again 3 days before closing. So my point is, you need to be an active buyer, and that get the documentation to the lender and be willing to provide additional documentation. You know, the other thing too is we used to be able to use credit reports that were 90 to 120 days old, bank statements, same thing. Now they've restricted to 60 days. So if you start the pre-approval process a couple months ago. We're probably going to have to update things. But more important than anything, and this is the advice I give today, this is the advice I gave 10 years ago, this is the advice I'm going to give 10 years from now. The number one thing that you need to do as a buyer is have a mortgage company run your credit. Don't go to freecreditreport.com. Don't look at the top of your Discover statement and see your little credit score. Two reasons why. Number one, the analytics that are used to generate mortgage credit reports are completely different than what the consumer gets. All the time I have consumers send me their credit reports and, no, I don't run my credit, I've already run it. And then I run it and there's never any correlation. Okay. I don't know why that is, but it is. A mortgage company is going to pull all three credit scores because we have to use the middle of the three. So having one score is great, but there's three credit bureaus and they all generate a score. We have to use the middle credit score. Okay. So that's really important to have the correct information. Okay. But part two of that, and this is definitely a benefit to anybody whose credit report I run it through this analytical that we have that says, hey, your score can increase this much if you do these certain things. We do that for free. Everything we do in the mortgage industry, credit score is involved in. Program availability, interest rate on the loan, cost of PMI. Somebody borrowing a $500,000 house that has a 780 score versus a 700 score, you think 700, hey, that's pretty good. Yeah, but it's not great. A 780 score versus a 700. I priced this out before I got on this phone, Elizabeth. That 700 score borrower will pay $10,000 more in closing costs than the guy at 780 on a $500,000 house for cost of points on their loan, cost of increased PMI premium. We're talking real numbers here. This is the biggest financial decision of your life. You have to walk in paired and not with one eye closed. You would never go out and sign the papers on a car without driving it first. This is a big financial decision. Get your ducks in a row. Get your credit report run early, first thing, before you even get on, Zillow or something like that and start looking at houses. That's my advice. And it's been that way. And I promise you, I'm not going to change.
Well, you become more passionate about it now more than ever because everybody is stuck in a basement. I mean, the last thing in the world you want is more heartbreak and heartache for your people, your clients. You want to get them to what their ultimate goal is. And that is, I visualize what we're in right now, and I'm dating myself, but like Bugs Bunny and Looney Tunes, where everybody's running in place and then they're going to take off running. We got to be ready to take off and run. We don't want to stay up here and then wait for gravity to pull us down. We want to take off and run.
Let's say you're going deer hunting and you're up in your stand, you're not your rifle and leave your bullets on the ground, right? If a deer comes along, oh, great, there's a deer. Well, now I gotta get my bullets, I gotta put in the gun and take my shot. By then it's too late. It's the same thing with credit scoring. I know we've had clients before that, oh my God, we weren't gonna buy a house. We fell in love with this house, let's buy it. And then we pull credit and then there's an issue.
And then there's heartbreak and heartache. And my job and your job is not only to work here, but work here and make sure we're setting people up for success.
Well, and the fact that we can do an analyzer and get you a better score, I mean, to me, the one pushback that I get from some folks is they say, hey, I hear that if you run my credit, it's going to hurt my score. Well, in theory, that could be true. In reality, we're going to have to run your score anyways. So it's not something that you're going to be able to get out of. And wouldn't you rather know what your score is now and then know what you could do to improve it instead of not have that information? It just baffles me that people say, hey, tell me what I can qualify for. Give me some numbers, but don't my credit. I mean, that's like going to the doctor and saying, hey, my arm hurts. And the doctor says, great, let's lift your sleeve up. And go, no, just tell me what you think's wrong, Right. So again, I can't stress this enough. Credit scoring drives everything in my industry.
Okay, cool.
It really does.
Aside from reaching out to me, everybody's real estate professional, how would somebody reach out to you? What's the best way?
Well, there's two ways. They can send me an email, or better yet, my cell phone is typically the quickest, easiest way to reach me. That's 703-967-189. You can call or text me. It's with me all the time. You can also go to my website, gregprotiva.com. On there, it'll allow you to fill out an application. You know, if you do decide to fill out an application, there's obviously no cost and there's certainly no obligation. But that gives me the ability to see your financial information and kind of need it. And it also does give me permission to run credit. So I do get people to fill out an application before they even contact me. But listen, I'm here to help you guys. I've got a long history of doing this and I've got lots of experience. And what I like to do is, I don't care if you're buying a 1-bedroom or 7-bedroom beach house. I like to pretend that I'm you, because I've bought and sold plenty of real estate. And I like to say, okay, I'm buying this condo or I'm buying this house. What would I do? Capture this. And so I like to give kind of a consultative approach instead of just saying, hey, here's what do you think?
Got it. Got it. All right. On a personal note, what's been your favorite room in your house?
Oh, the basement by far. I got my full bathroom down here. I got a refrigerator. It's quiet down here. But it's just weird, you know? I don't think I put gas
I know.
in my truck in like 2, you know? I mean, the money I'm saving is great, but I just feel bad for my dry cleaner. I feel like taking all my shirts that don't even need to be done, just taking it over to them. And I think I'm going to do that.
You must have, I think you were in our heads. Oh my gosh, we talked about that last night. We totally talked about that last night. That's hilarious that you say the same thing. That's hilarious. So, hey, thank you.
Hey, you think about it. Yeah.
Yeah, no, I know. They need us more than ever. I mean, truly.
But we need them. We might
I know.
not need them. Hey, we may not need them, but next month when you got to go to the office every month, you better have a dry cleaner to buy, you know?
Exactly. So thank you for the trigger,
Anyway,
because Dave and I talked about that last night. Hey, thanks, Greg, and I'll talk to you soon, okay?
Awesome. Have a great day. Take care.
Thanks. Bye.
Bye-bye.